Brian, over the last couple of quarters, you've talked a little bit about the two-act play and the idea that there's, and it's really kind of borne out as we envisioned. And over the last few months, you've said we probably should expect more volatility to enter the market as we move in through this year. And sure enough, that's happened over the last few weeks, where we did see the NASDAQ enter correction territory, which is to say the NASDAQ declined from its peak down 10%. That's not necessarily from the beginning of the year, but from its peak. And it's recovered some of that during the week this week as well. It's kind of been a little bumpier than we've had. The NASDAQ is not reflective of the entire market either. And it's maybe a little bit of a tale of different stories when you look at the Dow, or when you look at value versus growth. And you made some reference to these issues in our first hour, but I think these are points that are worth reiterating and reminding our listeners about. The composition of their portfolio needs to be diversified and thoughtful. And this is why we think about having a blended mix of how we structure a portfolio. You might also want to even touch on small cap, I guess, in this discussion as well. But where do you want to begin with all that?
Oh, that's a lot.
I know. I should call out there and leave it to you to take it up. Where do you want to go?
So I do think that the market right now has four distinct areas. I'd say that there are bubble stocks. That's very clear. There's a lot of bubble activity. You can see it, in things like GameStop having $100 swings within 45 minutes. I mean, I'm not saying that, I'm not going to point out which stocks I think are bubbles, but I think it's just clear that there's absolutely some bubble activity and some speculative activity going on. And then on the flip side of that, I do think there are some very cheap stocks. There are stocks that may have been penalized for, the COVID crisis, and maybe rightfully so, and maybe haven't come back to maybe where they should be. And I think those are interesting areas. And then there's some, and within those cheap stocks, there's also going to be stocks that may not recover. Maybe have lost their competitive advantage somewhere else during the COVID crisis. And that's something that you need to pay attention to as well. And then I think the bulk of the market falls into the other two categories. There's the stocks that are at fair value. Oddly enough, I think there's less of these today than normal. I think the other three buckets probably have more. And more often than not, I'd say that 75% of the market or more is at fair value, maybe even like 90%. But I think it's far less than that today, as these other buckets have really, there's really been some stratification in the market. And then the final one I want to talk to is stocks that are very expensive, but they might be good companies. And people are just paying a really big premium for, stocks that they think could, in time be revolutionary, for lack of a better word. So those are the things that I think that we're seeing. And there's definitely jump in anytime you guys are interested or have a comment. But I do think recently, and this, wasn't really a surprise, that the change in inflation expectations due to the COVID bills changed interest rates and affected these four groups differently, right? The bubble activity got really more bubble-icious. Things fell apart, then they wildly stormed back, and God knows where that place is going to go. You saw 30 to 50% stock drawdowns in certain issues. You saw SPACs that were really hot fall apart. You saw some more speculative funds that have been blowing the lights out kind of fall apart a little bit. And then you saw them also storm back to a certain degree. I have no idea where these types of markets are going. And I'd venture to say nobody really does. It's really just a casino.
These types of markets being those extraordinarily speculative parts of the market.
Yeah, and then the expensive but good, they also took it on the chin a little bit. But I think what you'll see is that they'll recover quicker, and they'll be a little less volatile than these bubblicious stocks. I'm not going to address the fair value ones because those are kind of dull. They they might have even rallied a little bit as people kind of went to them for safety. These are companies that have very predictable cash flows. The kind of companies I kind of love, actually, long-term compounders. And then the cheap stocks, they either remain cheap or slowly coming back. I think for the most part, you're starting to see them slowly come back from their deep discounts that they were in. And that's kind of how I'm seeing the market right now. I don't necessarily think that the dramatic climb in rates will continue in perpetuity. And that's just based on what I'm seeing for inflation expectations in the market.